This episode is brought to you by HubSpot. Now, did you know most businesses only use 20% of their data? That's like playing a football match with 1/5 of the team. It's going to be hard to win, right? Unless you have HubSpot. Their customer platform gives you access to untapped insights in emails, call logs, meeting transcripts, and all the other data you need to grow your business. Because when you know more, you grow more. Visit HubSpot.com today.
Hello and welcome to The Rest is Money. Steph's not with us today, but I'm delighted to be joined by Andrew Ross Sorkin, distinguished journalist from the New York Times, who I'm not sure if we've ever met, but I've certainly known you by reputation for...
Well, same here.
Goodness knows quite how long. Your excellent book, 1929, is a re-examination on the basis of an enormous amount of evidence that you've amassed connected to that extraordinarily important crash. What was your motivation for sort of immersing in what I think certainly within the last 150 years is still the most important crash?
The truth was that for me, I had read a lot of these books, trying to frankly understand that period better actually after 2008, because people would ask me to compare 2008 to 1929, and at least initially I didn't have a great answer. And there were great books. Kenneth Galbraith wrote the most famous one, The Great Crash, in 1955. And there were a number of others, some books written in the 30s and 40s, and another good one that was written, I think, in the 70s. But none of them, at least to me, brought you in the room with the characters, with the people, in a way where you really felt like you understood who they were and what their motivations were and what their incentives were. I always loved books like Barbarians at the Gate, and Den of Thieves.
Yeah, brilliant books.
And books of this nature that sort of made you feel this sort of immersive view of it all. And I thought there were so many interesting, fabulous characters that if you could tell the story through their lives, you really could understand this period in a whole new way. And that's really what I sort of grasped in what I sought to do. The challenge of it, of course, is these people are not alive. And so I really had to spend an extraordinary amount of time just collecting letters and memos and diaries and transcripts and depositions and all sorts of other materials, so that when you're in the room and you're seeing them quoted talking to each other, those are real quotes. So if they say, if I say this is what they thought in the moment, it's because that's what they thought in the moment, as documented somewhere. But finding all of that material was the great sort of puzzle mystery I was trying to put together.
And you were able, I think, to get hold of some material that had never been published before.
A whole bunch of material. In fact, the sort of great treasure map for me was convincing the New York Federal Reserve to give me their board minutes from that period. For reasons that are almost inexplicable, they had never been made public prior to this period. And we got in a big back and forth, you would call it a row, of trying to get these minutes from them. After a lot of debate, they finally actually had a lawyer go through them and send me redacted minutes. To which,
so what was still sensitive?
Well, so that's I said, how could this be? And so 6 months later, after that, then they sent me the actual minutes without the redactions, and
just out of interest, because it's
there was actually,
but what was it that they were worried about giving?
I don't know what they were worried about. There was a lot of information about banks, mostly small banks, not big banks, that were seeking lots of help from the Fed. At that point, as you might imagine.
Of course.
But they named them by name, and they had the exact amounts of money that they were seeking, and you could see the conversation that was happening. And for whatever reason, I think back then, they had told these board members that this was strictly confidential. It's no longer confidential because the minutes today actually are made public. I believe actually everything from the 50s or 60s on is made public. But for whatever reason, back then, they didn't want to make them public. But by having those minutes and all of the details from them, I was then able to go and find so much deeper in terms of knowing where all of my characters were at any moment, who they were talking to, and then I was able to go find archives of those individuals and their friends and family.
So we ought to remind people that what we're really talking about is a period of astonishing boom in the stock market, and a boom that was financed to a large extent by debt, by borrowing. This was what traders and economists would call leveraged investment, and that was the reason why that shock was, for example, so much greater than the bursting of the dot-com bubble back at the turn of this century, because back in 29, everybody and his wife was buying shares on margin. You know, when shares fall and you've got no collateral, you're left with what in many cases was ruinous debt. And if you then look at the bursting of the dot-com bubble, there just was less debt associated with that kind of, even though it was pretty hard going for people. I wanted, therefore, to bring us to where we are today. There's definitely elements of a bubble in terms of this great AI boom. How much of this AI boom, how much of a sort of an incipient bubble that we can see is like 29 and therefore highly dangerous, or a bit more like the dot-com bubble where it'll be painful but not ruinous?
So I think we don't know yet. I think the truth is that the 1920s look a lot like now in terms of the great euphoria around the technology itself. I mean, by the way, back in the 20s, we were talking about automobiles and telecommunications and radio. I mean, the stock RCA was the NVIDIA of its time. It was like a meme stock. What was happening in the 20s was people had access to extraordinary leverage. You would go into a brokerage house, which, by the way, were popping up on the streets like Pret-a-Manger's on every corner. You just walk in or to a hotel and you'd put down $1 and they'd give you 10. I mean, that was 10 to 1. So I don't think that is going on today at all. In terms of this AI bubble, what I don't know about the leverage piece is it's not coming from the investor class per se. It's more coming in how these transactions to buy data centers, build data centers, how much leverage is in that system right now.
And just part of that, the bit that I'm increasingly anxious about is, what we traditionally call vendor financing.
Yes, vendor financing. Red flag.
Where you're basically getting the creators, in this case, quite often of GPUs, these chips that power AI, effectively financing the AI businesses themselves.
There's no question. OpenAI currently does not have enough money to pay for the amount of chips that they are committing to buy. The only reason they're able to buy them is because NVIDIA is financing this. So that is clear, and that's a flag. But I actually think there's a lot more leverage in the system that is not even understood, which is to say that, the energy complex that is going to power all these data centers, all the build out, that is being financed by enormous amounts of debt. Similarly, some of the construction costs, some of the real estate companies that are building some of these things. I mean, there's a whole sort of subset of debt in the system that we don't know about. And the distinction that's even harder to understand, I think, is so much of it lives in the shadow banking system.
I was going to ask you about that. How much of this is
all
this booming industry of private credit?
It's all private credit, and we don't know what the marks are. We don't have the disclosure. Unlike 2008, we don't know where the leverage is. And so I think there's a sort of big question mark if, in fact, some of these AI companies, big and small, can't pay their bills. Sort of how does the whole system, does it collapse? Does it get just extended out into some, with private credit, some of these funds can get extended out into sort of these zombie-like operations. So it's not that necessarily it pops. It could be like a hiss for a very long time.
Yeah, it could.
And then the only other piece of this that I sort of throw a big red flag on is, back in 1929, there was a budget surplus in the United States. The government had practically no debt. And so when you think about what happens in a crisis, the right thing to do, I think we've learned in a crisis, it's what they didn't do in 1929, is you flood the system with money. I think we learned that in 2008. That's the better path, at least from a practical perspective. The problem with that, though, is today, what I don't know is, given how much government debt we have, if at some point, the bondholder community and the investor class raises their hand and says, we really don't like this anymore, and sort of can spiral you into sort of an even deeper crisis.
So I was with a group of fairly big investors the other day. There was this consensus, and and I just wonder what you think about it, that if the worst came to the worst, because so many of these AI bosses have got, close connections either with Trump personally or with people in the White House, they are all persuaded that if the worst came to the worst and there was a bit of a crash, that Trump would move heaven and earth to bail them all out. Do you think that's right?
The truth is, I think they probably are right in that, thus far at least, the only meaningful governor, I would argue, over this administration, meaning the Trump administration, thus far has been the market, one way or the other. We saw it with the bond market back when he announced the tariffs back in April. We saw it just actually a couple weeks ago with the equity markets when he made those comments about, tariffing China. And he has backed off every time he's felt that the quote-unquote marketplace was going to turn on him. So I do think, perhaps unlike other politicians, he would be more inclined to try to placate some of these business leaders and others to prevent a crisis. Interestingly, if you go back and look at what happened during the pandemic, I mean, he was the president of the United States during the pandemic, and it was during his office that, this enormous amount of money was just poured into the system. Bailouts for everybody. I mean, bailouts for everybody. Think about how politically unpalatable bailouts were after 2008 around the world. And then the pandemic happens, and we just spent money like drunken sailors, and nobody said a word.
Yeah, no, it is interesting. And it is, of course, one of the stark contrasts with 1929, where, you get a market crash that then leads to the Great Depression and unemployment of an incredibly painful sort, not just in America, but across the world.
And it didn't have to happen. I mean, that's the thing. The crash of 29, and the book is about the crash, but it's really actually about sort of the years that follow the crash as well. The crash itself was, to me, just the first domino, and then a series of other dominoes, which were otherwise terrible policy choices by the Federal Reserve, by the president, everything from trying to raise taxes in the middle of all of this, to implementing tariffs, to not spending more money. I mean, all of these things were sort of ultimately the dominoes that led to 25% unemployment in the United States.
They were. And obviously, and much of this was the sort of genius of a number of economists, especially Keynes, in understanding that governments do have a role. They can stimulate. And then we've got other economists like Minsky, again, who've increased our understanding of how these bubbles form, and obviously central banking understanding of the how you can create money in certain circumstances and it not be inflationary. So there've been huge sort of intellectual breakthroughs since then. But we shouldn't underestimate, certainly in a country like the UK, so much of the UK's economic stagnation, because this is an economy that's more or less stagnated since the crash, it stems from the fact we were massively over-reliant on City of London, a financial services industry, and we've not been able to re-engineer our economy sufficiently well subsequently to regain the kind of economic momentum that most British people think we deserve, and it's one of the reasons why our politics is fractured in the way that it has. In America, obviously, you have had an economy that has been much more vibrant in recent years than ours. But what do you see as the sort of lasting damage of 2007-8 in America?
I think the lasting damage is actually political damage more than anything else.
And how would you define that?
In the context of the undermining or the questioning of everything of institutions, of expertise, of all of. I mean,
so is it connected to the rise of Trump, then?
I think it's connected to the rise of Trump. I think it's connected to the rise of populism. I think that there's been a real sort of rethink about who you're supposed to listen to and who's really for the people, and that has clearly impacted things.
Which is we're on this because we're recording actually on the day that Mamdani has become mayor of New York.
Rise of Mamdani as well, no question.
And there's something quite striking about a city like New York, which is, I suppose, the nearest you have in America to the equivalent of London, with its dependence on Wall Street and financial services.
It is the capital of capitalism being now run by a socialist.
Which is fascinating, isn't it? And so, so again, I mean, is that in some way, is that the long tail, the long shadow of what happened in 2008?
I genuinely think that there is a long shadow of 2008 politically. I think it led to the rise of Trump in 2016. I think it's led today to the rise of Mamdani in now 2025. So yes, I do think that there's a rethink of what the establishment has done, and almost a backlash against the establishment across the board now in the United States. And one other just quick mention, though. You suggested that our economy, the United States, has managed to bounce back better than the UK. And the truth is it has, but it hasn't. If you really look at what's happened in the United States, so much of what's happening in terms of our growth has been powered almost exclusively, at least over the last couple of years, by all of the AI spending. If you were to actually remove AI spending, in fact, Jason Furman from Harvard, the economist, just did a fascinating study. If you take out all of the AI spending, you have growth that is literally flat. I think it's up 0.1%. So what's happening is it's almost papering over the rest of everything else that's happening in the United States economy in this moment. And I think that's another sign, or at least red flag to consider, given the concentration of growth is coming from one place and almost exclusively that place.
Let's unpick all of that in a minute or two.
This episode is brought to you by Wealthify. If you've ever thought, I should really do more with my savings, you're not alone. Most of us are busy juggling work and family life, so investing can feel complicated. Thankfully, Wealthify makes it simple. You put your money in, their experts take care of the rest. No picking your own stocks, no jargon, just a managed investment plan you can keep track of 24/7. Open a stocks and shares ISA, personal pension, or a junior ISA for the kids. And with over 100,000 customers and the backing of Aviva, you know your money's in experienced hands. Plus, when you deposit or transfer to a Wealthify stocks and shares ISA, you could earn between £50 and £1,000 cashback. Please note that minimum investments apply and cashback varies by the total amount of your deposit or transfer. So for investing, savings and pensions, the smart money's with Wealthify. Open your account today at wealthify.com. Wealthify is authorised and regulated by the Financial Conduct Authority. Offer registration closes on the 2nd of March 2026. T's and C's apply. With investing, your capital is at risk.
Welcome back to The Rest is Money with me, Robert Peston. I'm delighted that Andrew Ross Sorkin is still here. So I suppose there are two questions that follow from your absolutely correct statement that American growth at the moment is massively dependent on AI investment. I suppose there are two things to say. I mean, yeah, it might be a bubble, right? But this is still real investment.
Right.
And I suppose, I mean, one of my concerns would be, obviously, it is also fueling a big phenomenon that's been true, actually, of much of the West for the last 30, 40 years, and seems to me to be being accelerated, which is the kind of growth that we're seeing at the moment, the kind of booms we're seeing, are definitely increasing inequalities. Is that something you worry about in the context of the in a sense, the structure of the US economy? Essentially, it is just a great machine that makes a limited number of people unbelievably wealthy, but you also have large numbers of people who don't believe that the economy works for them, and that's another reason why you get so... I mean, there is this paradox that you've got the wealthiest,
right,
we think, president in history, but nonetheless he talks the language of unfairness all the time.
And I imagine it's going to become exacerbated even more, which is to say, here we are talking about, is there an AI bubble, and will there be a popping of the AI bubble? Let's say there's not a popping of the AI bubble. Let's say the AI bubble continues apace. Well, in great success, if in fact these valuations of these AI companies are to be believed, the only way they're going to be achieved, these valuations, is if they create shocking amounts of productivity. Well, what does productivity really mean? It means growth at a lower cost. How do you get to a lower cost? It means getting rid of people like you and me. And then you start to think to yourself, in success, you ultimately may have failure.
Whatever probability you put on AI, either enhancing productivity to the extent that vast numbers of people aren't needed, or indeed just purely totally just replacing humans. And there's a meaningful probability that will happen. If you're running a government at the moment, you should be preparing for what would be the mother of all economic and social shocks. You'd have to think about your welfare system, your education system, everything, right? None of them are having this debate, right, at all. So we all knew a pandemic would happen at some point. Nobody prepared for it. We know that there is a meaningful probability that AI will totally change our economies in a way that is destructive for millions of people's lives, certainly in the short term. And you've got to prepare for that, right?
But the complicated part is I think we don't know. I don't think we know what it would look like. I think we could scenario plan for 5 different sort of variations of how it might play out. But I think we don't really know yet what it's going to be.
Yeah, but you cannot know. Okay, so now I'm going to take us back to the thing that sort of, in a sense, is our sort of bond, as it were, which is the crash, right? We all knew, okay, that the kind of lending that was going on in the subprime market in the US was totally unsustainable, and anybody with half a brain knew that the value at risk models of the big banks were ludicrous in the way that they were basically saying there are no risks here. And we knew this for months, and then in some ways, years before the crash happened. And yet our regulators and our governments didn't prepare, because they thought, basically, well, who knows when it's going to happen? And, we don't know precisely what's going to happen. So nobody prepared, right? And this is the same kind. I mean, this, in my view, is a potentially way more worse social and economic outcome. And even if we don't know precisely what's going to happen, there should be at least some contingency planning going on.
Oh, I don't disagree with you. The question is, what would those contingencies genuinely look like? So there's sort of 2 parts to this. To me, one is how do you prevent whatever might be a popping of this bubble piece of it, which is to me around disclosure and private credit and trying to understand what's happening in that marketplace. But the other is a social issue. I don't know if it's social so much as an economic issue, which is, okay, let's say that there's mass unemployment in the United States or in the UK or elsewhere. Are we talking about UBI? Are we talking about tax cuts to allow people to afford? Are we talking about training? What does the training look like?
If everybody's unemployed, there is no income tax. So,
right.
So let's just say, the part of the answer is, certainly for a period, welfare support, a universal basic income, a system where governments essentially, finance people's living standards as the whole economy adjusts. But at the same time, there's no income tax coming in from millions and millions of people because they haven't got jobs. In those circumstances, somebody like Democratic Socialist Mandami is sort of probably in a better space than a Trump, because ultimately, if those who are essentially the owners of this technology, who are reaping presumably in these circumstances rewards beyond our wildest dreams, don't then make a contribution back, we're in trouble, aren't we? So this argument, I mean, we're not in a world, particularly in America, where it's easy to talk about redistribution. But in that kind of world, you have to talk about redistribution, don't you?
Oh, I think you'd have to have some form of redistribution. It's very hard to fully contemplate the magnitude of it. And even if Bill Gates, Jeff Bezos, Elon Musk, and Sam Altman or whatever, put all of their money together, and
then transferred it to the people,
and literally gave it to the people, it would still last. In truth, only probably 6 months. I mean, it really. I think it's a very interesting question.
Yeah, it's a terrifying question. Some bubbles, which when they burst, nonetheless leave you with really important infrastructure, right? So the railway bubbles, right? Nobody's complaining, wish we didn't have the railways today, even if there was a lot of excess and people lost a lot of money. I would say, actually, although it's perfectly clear that quite a lot of the digital revolution has done social harm, thinking about social media companies and the mental health problems and all of that, nonetheless, despite the fact there was a ridiculous boom and overvaluation in the stock market, around those original .com businesses, we are left with, real companies and real industries. I don't believe, if I'm completely honest with you, that the financial boom of 2007-8 left us with anything valuable. Do you?
Oh, no, I don't think the financial boom left us with anything valuable. The internet boom left us with something valuable, fiber in the ground.
Totally. Oh, that's also true. Yeah.
Which was real infrastructure.
And I think this boom is going to leave us with infrastructure. It's going to leave us with
here's where it gets more complicated.
Okay, here's
it gets more complicated
Okay.
because these data centers are basically buildings with chips in them. And the chips do not age well. That is actually the biggest distinction.
Yeah, that's
so
true.
the fiber in the ground has great value. The train tracks have great value. 3-4 years from now, you have to depreciate those chips
you gotta
as
replace
quickly
them.
as humanly possible, and you have to replace them. In 4 years from now, you will not want those chips.
Yeah, seriously.
And that is a real meaningful question as to what value all these chips are actually going to have in the future.
And what about all the power stations, the new
That,
nuclear?
no, and by the way, that will have value. We will need those. So there's part of the infrastructure that will have value and part of it that may not have value. Unfortunately, the biggest cost component of these data centers is the chips themselves.
Now, I'm going to bring you back to, I suppose, the sort of one of the biggest things that exercises certainly leaders in this country, but also across Europe. I mean, we've described an American economy that is flawed, but nonetheless has a momentum that Europe lacks. I mean, as somebody who sort of, looks at us from a little bit of a distance, what would you describe as the single biggest differences that mean that, in the end, the AI boom, and it might be a bubble, is focused on America and not on Europe? Why do you think that is?
It's a cultural issue, and it's actually articulated by Winston Churchill, who makes a cameo appearance in this book in 1929 when he's literally in New York as the stock market is crashing. And by the way, he also got bitten by the bug of stock speculation and lost his shirt in the process. He happens to actually see somebody he thinks jump out of a window from his hotel room at the Plaza Hotel in New York, and
this is 1929.
This is October 1929. He happens to be there. This is before he's the prime minister, and he writes after seeing this person, fall to his death, about the American economy and this idea of just the American culture of optimism. That the United and basically suggests that there's an optimistic nature to Americans and to this thing called the American experiment, and effectively argues that that the British people, frankly, should be more optimistic, that you actually need a bit of this sort of speculative feeling in the culture to create great innovation. In fact, I think he would argue that speculation is a feature, not a bug, that you need sort of that kind of optimism to get there. And it's interesting because, look, I'm a journalist. To some degree, I'm a professional skeptic. That is my job. But it has paid a lot better dividends over the last 100 years to be a professional optimist than to be a Cassandra. I mean, that has always been the truth.
Of course.
But I used to live here in the UK. This is 20 plus years ago. And it's true. I think as a people, the culture is such that we're always sort of looking at what's the downside, always at the risk, in a way that people in the U.S. don't always spend their time with that emphasis. They're always looking at what's the upside, And I think there's something to that in terms of why these things, why some of the great innovations have emerged out of the United States. And it's sort of
although I would slightly push back or challenge that it seems to me that many of the great innovations in terms of the fundamental research came out of Britain, and then they were massively exploited in America, and that's where all the money was made. That is the great frustration if you're British. You think, we had that bloody idea, why aren't we ruling the world
no question.
technologically?
Some of the great innovations out of Oxford, out of Cambridge. I mean, think about Demis at DeepMind.
Yeah.
I mean, amazing. And so much of that started here.
But it all started here, and then, of course, he sold out to Alphabet, and all the wealth now accrues to America, which is terrible.
I can't complain, but I appreciate the point you're making.
So I agree with you that I mean, funnily enough, this has been a theme of my entire professional career, which, I mean, there are two big British issues. One is, I think we are better than we were. I think, British people do take much more risks, and I think there is more of an entrepreneurial culture than there was, let's say, 30, 40 years ago. So that I think we're still, I mean, the thing we lack is the kind of financial system, financial infrastructure that helps a brilliant small business become a world leader, and that is still something we're not good enough at.
But part of that argument, I remember talking to Jeff Bezos about this actually a year ago, is that effectively the United States has built a venture capital community that is often willing to overspend.
It's amazing. So the losses that some of these venture capital firms are prepared to take, very few British institutions. I mean, one of the things I wonder about, and I've read a book that said this recently. I think that given we don't have private sector institutions here that have the risk appetite of so many Silicon Valley venture capital firms, I take the view that this is something that government should do. I mean, in the end, only the taxpayer really has a government that only governments can take the sort of long-term view.
Right.
I think that allows you to say, well, if we're going to make 100 times on this investment, we can afford to write off, a few others. But we don't have any infrastructure. But I think there is weirdly a role for government here.
I don't disagree with you. The question is, who is supposed to be making the choices? Because
you're definitely not ministers.
Well, that's what I was going to say. I was going to say in the United States, every time we have engaged in true industrial policy where the United States government has been making the investments itself, they have been abject failures for the most part. Is it true that the pension funds of different states and others that have then invested in these venture capital funds that are then allocated by these fund managers? Now, the rents that these venture capitalists are taking, by the way, from the pension funds are extraordinary. And I don't think it, in fact, would be as politically palatable in this country. Because the sort of fat cat headlines that you would see here don't exist in the United States.
So it is certainly the case that another hurdle that the UK has to get over in terms of its sort of collective psychology is we do have a sort of habit of confusing cheap with value.
Just to be 100% clear, I do think that some of these people are so vastly and wildly overpaid.
Oh, totally.
So I don't want to suggest for a second that this compensation is market-based. Oftentimes you think to yourself, there's clearly the no market, or it's a monopoly market, or that it's a manipulated market, or something else.
Totally. But that said, there is a sort of happy medium, which we're certainly not at, where, we, for example, many of our investment institutions will just go for the cheapest provider of services, but not really look enough about what the potential for returns are. And that seems to be something that we slightly have to get over. Now, I think on that constructive note, it's probably a moment where we have to draw this conversation to an end. I've really loved talking to you.
I love talking to you. We could do this for a long time.
We'll do it again.
Okay, please. Thank you.
Andrew Ross Sorkin, thank you so much for joining us today, and that's goodbye from me.
Thank you.